Have you ever sat in front of a crypto chart and had absolutely no idea what it was telling you? Not because you hadn't done the reading, not because you hadn't watched the videos, but because even after all of that, the chart still felt like noise. That feeling, that specific confusion is what this video is here to fix. Here's a story I've seen play out 1,000 times. Someone spent months learning crypto. They study RSI. They learn about moving averages. They watch chart breakdowns on YouTube every single day. They feel ready. They open a trade at what seems like a perfect opening. They're up 30%. They feel incredible. Then the market shifts. They freeze. They don't know if this is healthy or the start of a breakdown. They've never been taught how to tell the difference. So they hold. It keeps dropping. In the end, they panic sell near the bottom, right before the recovery. They did everything right. They studied, they were patient, they executed the perfect opening, but nobody taught them what to do during a distribution phase. Nobody explained that the chart was screaming warning signs for weeks, right before the move turned. The indicators were there, but the context to read them were not. And that is not an accident. The crypto content ecosystem is not trying to teach you how to trade crypto. It's teaching you how to follow, how to react. That's how they win. That's how they make money. That's their business. The average crypto investor buys the top 15% and sells in the bottom 15%. Not because they're uninformed, not because they're not trying, but because they're reacting instead of reading. Not having a framework doesn't just cost you entries, it costs you exits. Given back to the market because distribution looked like consolidation and breakdown looked like a buying opportunity. Every bull market creates paper wealth. Crypto has made a lot of people rich. Bear markets decides who stay rich. The investors who come out a full cycle ahead aren't always the ones who made the big gains on the way up. They're the ones who understood what was happening well enough to protect their capital on the way down. This video exists so that doesn't happen to you. My name is Adam, and this video is the cumulative knowledge of my entire research and analysis. Before we go into the levels, there's one thing worth saying up front. Most people try to invest in crypto based off news, social media, and gut feeling. That's why most people consistently leave money on the table or give it back entirely. Technical analysis is the language the professional side of the market uses to make decisions. It's how serious participants reprice, track capital, and position ahead of the moves, rather than after them. It's not about drawing lines on a chart. It's about understanding behavior. And behavior is consistent, repeatable, and readable once you know what to look for. This video is how you learn to speak that language. Here are the 3 levels of this video. Level 1 is basics. This is price, just price. What direction it's moving, where it's relative to value, and where are the meaningful levels. Level 2 is intermediate. This is capital rotation. Crypto doesn't move as a block. Money moves between assets, and it does so in a predictable way. Level 2 teaches you to track the rotation, get ahead of the next move before it happens. Level 3 is expert. This is context and execution. Market phases, scenario building, positioning, and invalidation. This is where analysis becomes a system, not just understanding what's happening, and knowing what to do about it. By the end of level 1, you'll be able to look at any chart and know exactly which direction price is headed, whether it's at a discount, overextended, and where the meaningful levels actually are. By the end of level 2, you'll understand exactly where capital is moving across the entire crypto market, not just the assets you're watching. By the end of level 3, you'll be able to sit down with any asset, build 3 complete scenarios on what you would do in every single case. Level 1 gives direction, level 2 gives you context, level 3 gives you a system. Miss any of these and your analysis has a gap. Gaps lead to bad decisions. I've seen it thousands of times. Investors with genuine chart knowledge making avoidable losses because one layer was missing. If you're happy following signals and reacting to price moves, this isn't for you. There's plenty of content out there for that. This is for the investor who wants to understand why something's happening, not just what's happening. The guy who wants to be the one in the room who knows why the market's doing what it's doing, not just what it's doing. If that's you, you're in the right place. Let's start the foundation of our pyramid. What is the actual point of technical analysis? Because if you don't understand that, and most people don't, the tools and frameworks I'm about to share will just feel like a collection of rules to memorize rather than an actionable system. So let's start at the bottom. At its core, every market in the world, crypto, forex, commodities, stocks, it's all a two-sided auction. On one side, you have buyers. They believe the asset is worth more than its current price, so they buy. On the other side, you have sellers. They believe the asset's worth less than the current price, so they sell. When buyers are more aggressive than sellers, prices go up. Sellers get forced out, buyers push it higher. When sellers are more aggressive than buyers, price comes down. Buyers get forced out, sellers push it lower. That's it. That's the entire engine underneath every single chart you ever see. Every candlestick, every level, every pattern, every move, all of it is just a visual record of the battle between buyers and sellers. The ultimate goal of this dynamic, finding the fair value of a given asset. Fair value is the price in which buyers and sellers reach a consensus, where both sides are comfortable transacting. When the price is at a fair value, you get a range. Both sides are participating, neither is dominant, the market is balanced. The moment that balance shifts, new information, sentiment changes, a large player enters or exits, one side gains dominance and the market moves away from fair value and the game resets. Let's get back to balance. This is how trends form, not randomly, but because participants' collective beliefs about what something is worth has shifted. So when you see a range in market on a chart, you're seeing agreement. When you're seeing trending markets, you're seeing disagreements. And when you see a false breakout of a range before a sharp reversal, you're seeing a manipulation move. One side forces price into an area that the other side stops are clustered. That triggers a liquidation, collects that liquidity, and then moves aggressively in an opposite direction. That reversal isn't random. It's a natural consequence of one side running out of participants willing to transact at that level. That's what it is and why it's useful. Now, there's a common objection to technical analysis. Past price action has no real bearing on future price action. And on the surface, that's a fair challenge. But here's the counter. Markets aren't driven by algorithms. They're driven by humans. And humans' behavior repeats. Fear repeats, greed repeats, the way participants react to uncertainty, panic, losses, euphoria, it all follows a consistent pattern. Not because of some mystical law, but because psychological responses driving those reactions are hardwired into our DNA. What we're reading on a chart isn't just numbers, it's psychology made visual. Every wick, every rejection, every breakout and reversal is the collective emotional response of thousands of participants recorded in price. Japanese candlesticks, which is the chart style most used, were developed in the 18th century to track the price of rice. The underlying insight was that price movements weren't random. They reflected the emotions and expectations of the market. That insight is as true today as it was back then. Once you stop seeing candlesticks as abstract data and start seeing them as a footprint of human decisions, fear, confidence, panic, conviction, everything starts to make more sense. One more concept before we go into bell levels. Not all time frames are created equally, and understanding why changes how you use them. Higher time frames, the weekly, the daily, even the monthly, carry more weight because they represent larger flows of capital and different types of players, the institutions, the funds, the whales. Their decisions create structural moves that everything else plays within. Lower time frames, the 4-hour, the 1-hour, the 15-minute, represent smaller flows and shorter-term participants. Day traders, scalpers, short-term players. When you look at a daily chart, you're seeing the footprint of larger capital making longer term decisions. When you look at a 15-minute chart, you're seeing faster, smaller participants reacting in real time. This is why higher time frame structures matter more. A level that's held weekly for 6 months represents a price at which larger capital has repeatedly decided something is worth transacting at that level. That is a very different thing to a level that formed on a 15-minute chart this morning. The game being played on the weekly is not the same game being played on the 15-minute. Both are real, both have players, and both present opportunity, but they operate completely differently. And when they conflict, a higher time frame usually comes out on top. Think of it like this. You're on a small boat. The waves on the surface are lower time frame. Fast, constant, visible, but the current underneath is a higher time frame. Slower, less visible, but far more powerful. You can fight the surface waves all day long, but if the current is running against you, you're losing ground. That's the foundation. Two-sided auction seeking fair value, charts with a visual record of that process. What you're reading is human psychology, and higher timeframes carry more weight because they represent larger capital. Everything in levels 1, 2, and 3 are built on top of this. The tools I share with you now will make more intuitive sense because you understand what they're actually measuring. So let's go right into level 1. Basic. Price understanding. Topic 1. Structure defines direction. The first thing you need to understand about price is direction. Before indicators, before moving averages, before anything else, you need to know what the market is actually doing structurally. This is market structure, the cleanest, most reliable form of analysis available to everyone. And this is where everything begins. Here's how price actually moves. And this is the model most people never get taught properly. Price sets range first. Always. It consolidates between two levels, a high and a low. Energy builds, liquidity builds on both sides. Either it continues and price breaks clearly above, and then one of two things happen. Either it continues, price breaks cleanly in the direction of the prevailing trend with conviction, volume backs it up, and the move follows through. That's continuation. Straightforward. The market showed its hand and followed through. Or it manipulates. This is the one that trips most people up. Price breaks out on one side of the range, let's say above the high. Traders see it, they buy the breakout, and then almost immediately, price reverses and moves aggressively in the opposite direction, wiping people out. That's manipulation, a false breakout, specifically designed to trap traders on the wrong side before the real move happens. This is the pattern I see costing people the most. They see the breakout, they chase it, and within hours, they start wondering what on earth happened. What happened is they got trapped. The manipulation moved, wicked through their stop, collected that liquidity, and the real move began. Once you see this pattern, you see it everywhere. The full model looks like this: range in either continuation or manipulation. Then the real impulsive move. If price breaks above that range and holds, continuation to the upside. If price breaks above the range, traps buyers and drops aggressively back below. That was manipulation. The real move is down. If price breaks below that level and holds, we see continuation to the downside. If price breaks below that range, trap sellers, then pumps aggressively back above. That was also manipulation. The real move is up. The manipulation move is your tell. When you see a sharp break of range level followed by an equally sharp reversal, do not fight it. That reversal is often the beginning of the impulsive move in the opposite direction. Higher highs and higher lows across multiple ranges equals very bullish structure. The market's making progress towards the upside. Lower lows and lower highs across multiple ranges is the opposite. Every rally gets sold into. Sideways with no resolution, no clear edge, no trades to be made. Structure tells you direction. The range manipulation move model tells you the story behind that direction. Learn to read both. Topic 2, price rotates between value and premium. Once you understand structure and direction, the next useful layer is context. Where is price within the bigger picture? Has it come a long way from where it started? Is it extended? Is it near long run average? This is where the 200 EMA adds value, and we want to be precise about what it is and what it isn't. The 200 exponential moving average is a lagging indicator. It tells you where price has been, not where it's going. We do not use this as a signal. We do not trade off it. We use this as context and confluence, particularly on higher time frames such as a weekly chart, where it gives you a meaningful read on where the price is extended relative to its long run average. Think of it this way. There's always a center of gravity, the zone that represents long run average for an asset. Price moves away from that zone, gets extended, and eventually gravitates back to the center. The 200 EMA on the weekly is a reasonable proxy for that zone. When price is trading significantly above that level, that doesn't mean sell, but it's a sign we're probably not buying at fair value. And the same thing on the opposite front, when price is significantly lower. When things are super low, fear tends to be the highest here. But that doesn't mean buy blindly. But it does mean context is different from chasing all-time highs. The key word here is context. We're not saying price above 200 EMA means overvalued, and we're not saying the opposite. We are saying you can use this as a reference point, not as a replacement to your analysis, but a reference. Now, we have RSI, the Relative Strength Index. This measures the momentum behind the move, essentially how fast and how hard that move actually is. Think of it like a speedometer. When the speed of buying slows down, even while price is going up, and something is changing beneath the surface. The divergence between what price is doing and what momentum is saying, that's where the signal lives. Unlike the 200 EMA, RSI is a useful confluence tool, particularly when it aligns with what structure is already telling you. If price is extended above its long-run average, making higher highs, but RSI is making lower highs, that's a bearish divergence. Momentum's fading. The buyers are losing. The context is overextended and momentum is weakening. That combination matters. This works the same way in the opposite direction. Back in November 2022, Bitcoin crashed to around 15K, deep below the 200 EMA. Fear was at an extreme. Most people were selling or completely checked out. But that deep extension below the long-run average, combined with RSI making higher lows while price made lower lows, was one of the clearest confluent setups in Bitcoin's history. By the end of the year, Bitcoin smashed $40,000. This setup was so clear and visible, but most people missed it. Why? Because they were reacting to headlines, not what the charts were telling us. Price does not move randomly. It never will. It stretches from its long-run average and then it reverts. Divergences at extremes uses confluences. A long structure will tell you when the reversion is likely. Topic 3, reaction-based levels. The third component of level 1 is understanding what makes price a meaningful level. This is the one that winds me up the most. You watch a guy, DimTA on YouTube, he draws a line around 50,000 BTC or 3,000 ETH and calls it support. Price blows through this number and people get confused. The round number doesn't matter. What matters was whether real money had actually reacted there before. If you see a guy plotting 50k Bitcoin and 3k ETH, probably a sign this guy is full of crap. Real analysis, real numbers. Meaningful levels are not drawn. They're identified by the way the market reacts. A level is only significant when price has shown a strong, decisive reaction to it. A sharp bounce, clean rejection, a high volume reversal. That reaction tells you that participants with real size were active there, and they're likely to be active there again. What you're specifically looking for are demand areas, zones where price moved aggressively away from, rapidly, with momentum after a tight consolidation. That aggressive move tells you significant unfilled demand was left behind. When price returns, the demand reactivates. The 3 principles to remember: draw a zone, not a line. Confluence counts. If a level shows up on the daily and the 4-hour, it matters more than the one you can see on the 15-minute. Lastly, recency wins. A reaction from 3 weeks ago is a lot more significant than a move 6 months ago. Markets evolve. old levels change. That's level 1 complete. 3 tools that will give you a more coherent read on any chart than more than most people ever develop. But price in isolation only tells half the story. The other half is where the money is actually going. Level 2, intermediate. This is capital rotation and market environment. Most investors watch one asset at a time. They stare at a single chart trying to figure out what's next. The problem is that crypto doesn't move in isolation. Capital flows between assets, and understanding that flow is what separates someone who can read the chart from someone who can read a market. Level 2 is about developing that wider lens. Topic 1, rotation between majors and ratio analysis. Let me introduce you to ratio charts. This is one of the most powerful but underutilized tools in all of crypto. A ratio chart is one asset's price divided by another. ETH BTC shows how Ethereum is valued relative to Bitcoin. Not in absolute terms, but relative ones. If ETH BTC is rising, ETH is outperforming Bitcoin. Capital rotating out of Bitcoin into ETH. And historically, when this happens, it signals a risk on environment. Very bullish, we're going to see more rotations into altcoins. Because the money doesn't stop at Ethereum, it continues up the risk curve. If ETH Bitcoin is reversing, the same goes. It means people are risking off. Bearish sign. People will come and say, oh, my alt's up 20%, I'm doing great, but Bitcoin's up 35%. Underperformance is underperformance. A tactic I typically use is denominating my success in Bitcoin. It's both humbling in bull markets and very comforting in bear markets. Ratio analysis works on emerging assets too. Hype Sol and Hype ETH are something we're keeping a very close eye on right now. When Hype is rising relative to Solana and Ethereum, it tells you that capital is flowing into a particular direction, not just riding the broader market. That kind of relative outperformance against strong majors is one of the clearest signals that an asset has genuine momentum behind it, not just a rising tide. It's the difference between an asset moving with the market and the asset leading the market. Price tells you what is happening. Ratios tell you where the opportunity is moving to. Topic 2, dominance as a market environment gauge. 3 dominance readings, all essential, and most investors track one at most. First, Bitcoin dominance. This measures Bitcoin's share of the total crypto market cap. Bitcoin dominance means capital is concentrating in Bitcoin and also underperforming. Avoiding BTC dominance is the opposite. Money is moving out of BTC into the wider market, into alts, typically very bullish. Second, combined stablecoin dominance. This is USDE and USDC combined. Most people ignore it, but it's one of the clearest signals for the crypto market and something you need to be looking at for your analysis. Rising stablecoin dominance means money's moving out of the crypto market into stables. People are concerned. People are worried. People are risking off. Same in the opposite direction. Stablecoin dominance goes down, money's flowing in. People are risk on. People are confident. Expect the markets to move up. Sometimes the assets you're watching are in consolidation. No clear signal up or down. Before you write it off, keep an eye on stablecoin dominance, because if it's trending down, that almost preludes capital moving to the market. And we'll probably see rotation from stables to Bitcoin, to big alts, to small caps. Third, and this is one that nobody's really talking about, Bitcoin dominance plus combined stablecoin dominance together. When the combined reading is falling, something specific is happening. Capital isn't just rotating out of Bitcoin, it's rotating out of Bitcoin and alts simultaneously. That means money's moving out of crypto. That's the most aggressive form of altcoin rotation. Most investors will never look at this chart, which means when it fires, they're already late. The key with these 2 charts is to find a pattern, and it really gives you an idea of, are we risking on or risking off? Topic 3, time frame alignment. We already talked about the importance of time frame. So what happens when we look at them collectively? Most losing trades don't happen because of direction. They happen because of timing. People are watching the wrong environment. We see this pattern constantly across the investors we work with. Someone shoots us a message after losing a trade and says, hey, can you please review my analysis? Where did I go wrong? And we pull the setup together, clean 15-minute chart. Demand zone held, volume looked good, RSI in the right place, a textbook entry on a lower time frame. But on the daily chart, price was below its long-run average in a clear downward trend. BTC dominance was climbing, ETH BTC was falling, the rotation hadn't started. The entry was technically correct, but the context was completely wrong. That single blind spot costs investors more than any other mistake I see in crypto, and it's entirely fixable. Higher timeframes should define your bias. Lower timeframes should define your entry. The daily and the 4-hour are where you need to read structure, identify where price sits in the bigger picture, and establish a directional thesis. Is price bullish or bearish? Has it just completed a manipulation move? Where are the key levels? These questions get answered at the top. The rule: if your lower timeframe entry conflicts with your higher timeframe, do not take the trade. Probability of success absolutely collapses. When you start your day, establish bias, move to the 4-hour, confirm structure, then go lower for entry. When all three things align, it's a very high probability of success. If your trades go against a higher time frame, that doesn't mean you're going to lose, but you're really putting yourself in a tricky position that's not worth it. It's not about the volume of trades you make, it's making high quality trades. So let things align. That's level 2 complete. You can now read price and you can read the broader market environment. You know where capital's concentrated and you know where it's rotated to. Now let's move on to level 3. This is for the experts. Context, scenarios, and execution. Topic 1, market phases and when to trade. Every market moves through phases, 4 of them to be exact. You can't apply the same approach for all of them. Every single one is different. This is something that catches 99% of traders off guard. Phase 1, accumulation. A range, low volatility, no clear trend. Price oscillates between 2 levels without conviction. This is where patient, informed investors are building positions. Most retail participants are bored looking somewhere else. Accumulation can be the least exciting phase, but it's often the most important one. That's where you get positioned. And it's where the range manipulation move model plays out most clearly. The manipulation of the range lows and the range highs is often the final move before the real impulsive moves begin. Phase 2, the impulsive move. So price breaks out of accumulation, range with conviction, volume increases, volatility increases, structure shifts from sideways to directional. This is where the real moves happen. And if you've been reading structure and waiting for manipulation to play out, you're positioned for it rather than chasing it. Phase 3 is distribution. The top formation. Price has had a significant run and begins ranging again at elevated levels. Smart money offloading into retail, RSI diverging, volume on rallies declining. Distribution often looks like continuation, right up until it isn't. This is where overconfidence is most dangerous. Typically, peak bull markets and bottom of the bear markets. Lastly, phase 4, the breakdown. The downtrend that follows distribution. Lower highs, lower lows, capital exiting, risk, sizing its targets only to adjust. The brutal reality of when most investors get caught, they discover a project during distribution, it's getting maximum coverage, maximum social attention, maximum hype. They buy at the top of the range and they hold for the entire breakdown, wondering what went wrong. The phase was screaming at them the whole time. They just didn't have the framework to hear it. In accumulation, the edge is patience. Wait for the manipulation move and the real impulsive move to confirm before committing sides. In the impulsive move, hold and trail. In distribution, take profits, reduce exposure, watch for exhaustion. In breakdown, stay out. Most investors are still buying during distribution and still holding during breakdown. Understanding the phases changes everything. Topic 2. Scenario-based framework. This is the core of the system and the part that genuinely separates the professionals from everyone else. Most investors approach the chart with a clear idea and they're looking for confirmation bias. It's either going up or it's going down. Then they look for reasons to confirm that thesis. That's not analysis, that's bias. Professional level analysts work completely differently. Every setup, they map out 3 scenarios: bullish, neutral, and bearish. For each one, the parameters have to be established beforehand. What price action would confirm it? We're not predicting direction, you're preparing for various outcomes. Here's how it works in practice. Bitcoin is in a range. Below its long-run average, ETH BTC is falling, Bitcoin dominance is rising. Bullish scenario, Bitcoin sweeps the range low, manipulation move, then reclaims the range and pushes above the range with high volume. Structure shifts to higher highs, ETH BTC stabilizes, bias flips, bullish. Position for the impulsive move. Same situation, but neutral scenario. Bitcoin bounces within the range, but fails to break either side with conviction. Continues oscillating, wait and see, no high conviction position. Bearish scenario. Bitcoin breaks below the range low and holds below it. Continuation to the downside. No street back above, volume picks up to the downside, bias remains bearish. Priority is capital preservation, not buying the dip. When you've mapped out all three scenarios in advance, you stop dreading the move. You've already decided what you're going to do in every single case. The market moves, you execute. There's no panic, there's no second guessing, no checking Twitter to see what everyone else thinks. Professional traders aren't guessing direction. They're mapping possibilities and they know in advance what they will do in each case. Topic 3, positioning and invalidation. The final piece of the puzzle, and arguably the most important, is positioning and invalidation. Entries matter less than location. Buying at a demand zone, after a manipulation move, after a fake out is already played out and the price is reversed, is fundamentally different from chasing the move once it's already extended. Asset might be the same, the direction might be the same, but the risk-reward profile is completely different. Entering after the manipulation, when the fake out is confirmed and the real move is beginning, gives you a natural reference point. The manipulation, low or high, is your invalidation. Your risk is tight. If the move is genuine, the reward relative to the risk is significant. Chasing the move after the extension gives you none of that. The stop is far below. The risk is high. The reward for the stretched entry is much lower. Location should determine your risk reward before the trade even begins. Now, the invalidation. And every trade and investment you have should have an invalidation. The question you must ask yourself before any position is, where will I need to change my mind? What could go wrong for me to change my opinion? That's your invalidation. That is where your stop goes. And when that price stop list hits, you close, full stop, no moving, no adding to a position. What you're actually doing is redefining your risk in real time because of your emotions, especially when your emotions are most high. You're doing everything in your power to convince yourself you weren't wrong. You weren't an idiot. You didn't make a mistake, but you can't win like that. You don't have to get it right. You just have to stick to a plan. You gotta honor it. If this thesis is dead, you exit. You protect capital. There will always be other opportunities. The best traders in the world aren't the ones who always get it right. They're the ones who lose the least when they're wrong. When the system's dialed in, a volatile week stops being stressful. You sit down, you run the steps, and you know what you're watching for the entire week. You've mapped your scenarios. The market moves, you execute. No need to panic. No chasing, no reacting, no keeping an eye on Twitter at midnight to see what's shifting. That's the framework. That's what it gives you. Not a prediction, a process. That's level 3 complete. You now have the full system. Let's bring the framework together. It's 7 steps, but it's one unified system. Step 1, identify structure. Is price in a range? Has it made a manipulation move? Or has it continued directionally with conviction? What is the overall bias? Higher highs and higher lows, lower highs and lower lows. Step 2, identify the context. Where is price relative to its long-run average on a higher time frame? Is it extended above at fair value or deep below? Are there any momentum divergences forming at the extremes that add confidence? Step 3, analyze the ratios. Which major is leading? What's lagging? Is BTC ETH rising or falling? How are assets like HYPE performing relative to Sol and ETH? Where is the rotation headed? Step 4, check dominance. Stablecoins, rising, falling, capital concentrating or spreading. Are we risk on or risk off? Is Bitcoin dominance, the stablecoin dominance falling together? That's the most aggressive form of altcoin rotation. Step 5, identify the market phase. Accumulation, impulsive move, distribution, or breakdown. What does the phase tell you about the right strategy and the right level of exposure? Step 6, build your scenarios. Map the bullish, neutral, and bearish cases. Define the confirmation triggers for each. Know in advance what you will do if those levels are hit. Step 7, position accordingly. Location over the perfect entry. Ideally, after a manipulation move is confirmed, not chasing extension. Validation before the position is open. If it hits, you close. No exceptions. That's your checklist for every chart, every week for good. No guesswork, no reacting to headlines, not chasing a move that's already happened. A systematic, repeatable process that works in every market. I want to leave you with one final thought. Technical analysis is not about indicators. It never was. It's about understanding behavior, price behavior, how markets set ranges, manipulate one side to trap traders, then make the real move. Capital behavior, how money rotates between assets, concentrates in levers, and signals the next move before it happens. And your own behavior, how you manage uncertainty, how you plan for being wrong, and how you execute without emotion. At the start of this video, we spoke about the feeling of sitting in front of your computer and being confused by a chart. All you're hearing is noise, not knowing what you're looking at, not trusting yourself to make the call. That confusion has a cost, not just entries, but exits. Positions you hold too long because you didn't know what the breakdown looked like, gains you give back because you chased a breakout that turned out to be a trap. Now, you understand how price behaves, capital behaves, and how you behave when you interact with these forces. The chart is no longer confusing. You now speak the language. The chart that felt like noise when you press play, you can read it now. Thanks for watching.